Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Green is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome to the Private Equity Profits Podcast. I'm Cliff Locks, your host, and with me today is Dr. Patrick. He's the managing partner and CIO of Kontora Family Offices, and Kontora Family Offices is a multi-family office based in Hamburg, Germany. Established in 2006, the firm provides services to families, single-family offices, and nonprofit organizations, such as foundations, associations, and religious institutions, especially as organized institution assets in Germany. It follows the American family office business model, operating fully independently. Welcome, Patrick. Thank you so much for taking the time. Let's start a conversation with the personal note. How'd you get started in private equity space?
Hi, Cliff. Thanks a lot for having me on. At Cantor, we've been investing in private equity for 16 years now. Actually, before Cantor, I did my PhD on private equity aspect. Well, it was basically turnaround management in small and medium-sized companies in Germany. So I've been attached to the space for many years. Probably most of our families are invested with about 20% of their net worth in private equity. So it's something that's very close to us.
What distinguishes Cantor from other advisory services in the space?
Put it this way, I would say we don't distinguish ourselves a lot from the standard American model of the single family office or the multifamily office. It's very different in Germany. Most people get their financial advice in the banking space. They would go to a Deutsche Bank or to Goldman Sachs or to some of these names, or a local regional bank, and just do some bond and stock portfolio, and that would be it. At Kontora, we very much believe in illiquid investments. So an allocation of our clients could be 60% illiquid. So you will find a lot of real estate project developments, you'll find venture capital, you'll find private equity, you'll find some funny alternative stuff like a container portfolio based in Singapore, or we are invested in cocoa plantation in South America. So you'll find a very international, diversified portfolio. We try to drive down the correlation between the assets to get robust portfolios for our clients. I suppose that's the main difference to the other German players in the field.
You carved out a very unique business model there. I want to salute you for that. That's a breath of fresh air. We take it for granted here in the US, but in Germany, it's very, very different. It's a privilege interviewing you and learning and listening. Can you summarize your approach to investing?
Absolutely. Well, when it comes to investing, it's basically two areas that we draw our ideas from. The one is when it comes to financial returns, the most important question you have to ask yourself is, how do you divide your wealth between the different asset classes? So the so-called strategic asset allocation is the main driving point for robust and stable returns. So that's the main thing. And we look at the US, especially to the endowment model that has been pioneered by David Swensen at Yale, but also others, Notre Dame, MIT, Seth Alexander is also a big, for us, a hero. So we very much look at these guys, what have they done? And then we kind of adapted it a little bit for Germany. But in the end, it's the same ideas. That's the strategic asset allocation. And when it comes to picking individual investments, we very much bottom-up guys. Well, I would say it's the value investing philosophy That is very at the heart and core of what we do. But we try not to stay at, what has Ben Graham said and what is numbers that he looked at. We try to, like most good value guys nowadays, look at what does it mean going forward. For example, most guys look at what is then the moat doing in the future. So we look at how will the competitive advantage develop over time. For example, if you look at a business model like Google, say, okay, is that moat growing or is it shrinking or is it staying where it is? And when it's growing, it might be a value perspective to say, well, this is actually a very undervalued company. Whereas the traditional value guy would say, oh, that's a very expensive company for some reason. Yeah, these are the two areas where we draw most of our ideas from. Yeah, looking around, Seth Klarman, for example, is a big hero of us, based in Boston, very much looking at margin of safety for each and individual investment. We try to find investment with big margin of safety. Mostly what we do, actually, we always look at what can go wrong and then try to get good returns from that.
So consistent, solid returns and looking at the risk profile. Very good.
Yeah, the funny thing is when you primarily look at the risk side, you end up with really good returns. we track it quite, precisely. So in the history of Kontora, we have advised our clients on 169 investments. Mm-hmm. So we can pretty much say what are the returns of these. For lots of the illiquid stuff, they still run. So, I mean, if you do a private equity fund and that runs for 10 years and we've done the investment 5 years ago, we can't finally say where the IRR will be. Mm-hmm. But for the investments that are finished already, the IRR is at 14% after costs. It seems to work.
Very positive. What do you mean by thinking and working in modular units, and what is the benefits of this approach to your clients?
Yeah, that might be an advantage we have here in Germany because most competitors, they have a model where they say, well, client, I will do everything for you. Please come to me. I do the all number crunching for you. You can do investments with me and you have an all-in fee model. We do all the administration and the investment, and et cetera, everything for you. Our model is different in that we say it's fine that people, also single family office, can come to us and say, we have the administration in place already, but we really need deal flow for private equity or real estate in the US, for example. Mm-hmm. And then we could say, yeah, that's no problem. We show you our deal flow and then you just pay for these services. And others might say, we do all our investments ourselves and we have 70 PE funds, for example. Mm-hmm. And could you just do the administration for us? So we are basically their workbench, providing them with all the numbers and we get the quarterly results and we do all the bookkeeping for them. So that would be a different approach working with Kontora. And then other families come and say, we have 4 kids. They have no idea about investing. We are all fine. Maybe the husband, he has built up his wealth and he says, well, but my kids will inherit this at one day, but they have no idea about investing. Can you teach them? That's actually quite a big thing in our whole portfolio of services that we provide an academy program where we very individual. Some say, can you just do some education in the different asset classes? And we would say, okay, there's one module where we explain how does listed equity actually work, and one will explain, well, how do you invest in real estate? And one would say, what about private debt? We would then go about explaining all these things because we very much believe actually also be a German thing. Over here, most asset managers, they come to the clients and say, it's great that you're here. It's wonderful. Now you don't have to worry about anything. Just give me your money and I will take care of it. And the typical entrepreneur in Germany will panic at these sentences because, usually he did the decisions and he was very good at deciding stuff. And now there's somebody coming along who wants to take all this away from him. What we try to do is say, look, what you've always done, this is for the kids, but also for the guys, for the successful entrepreneurs. You have done your decisions very well in your space. And now suddenly you want to invest in venture capital, for example, or real estate, which you have never done before. So we will kind of teach you all you need, take the decisions in the future on the same solid ground. Yeah, that's pretty much our approach.
I'm proud of you. What is your approach to identifying the most objectively suitable financial service partners for your clients?
I think it's a two-way process. On the one hand, of course, when it comes to investments like private equity, for example, you have your league tables, you have, everyone, it's very transparent. What's the best track record? Who are the guys you want to invest in? I don't know. For example, venture capital, well, you want to invest with Andreessen Horowitz or Sequoia or Benchmark, and then your only problem is, will they give you allocation or not? Well, that's the easy part. So you work on your network, you try to, get the connections to be able to invest with the best guys on the planet. But then when it comes to stuff like listed equity, we are more a contrarian, in the contrarian side of who we like to give money. So for example, most asset managers, I think that's actually globally, will say, well, we have a diversified portfolio of 30 to 50 companies, and that's a very concentrated portfolio. And then that's when I panic, because a concentrated portfolio is something between 10 and 15 companies. You don't find that in the normal institutions like a bank or a huge asset management firm, but you do find it with one captain ships. We look for these guys who have a setup where they do their investments, but basically they concentrate on investing in a concentrated portfolio. And they have spectacular returns. This is purely basically getting to know the guys, trying to find these guys at conferences, in going to Omaha. I mean, I didn't go the last 2 years, but we go to Omaha, meet guys at the Berkshire AGM, and you get your network of guys who actually do these style of investments. Have to do a lot of explaining when the families come to us at first, because I mean they have heard all their life that you need 30 to 50 companies in a portfolio for it to be a meaningful portfolio, and so that takes a lot of education actually. But most families end up in these style of investments.
That leads me very nicely into, what are the main differences in private equity markets in Asia, America, and Europe?
Well, that's a very broad question, a very good question. I mean, for me, the best private equity managers are still found in the United States. I mean, this is where it originated. This is where the best guys are, and where the innovation actually, I mean, the structural innovation, how to invest in the private equity space comes from. I would always tell our families, when you want to invest with the best private equity guys, you need allocation in the United States. Then in Europe, you have some very able managers. Probably the markets are not priced to perfection the way it might be in the United States. But then again, I always think most families have a home bias. That's everywhere on the globe. But we have the same in Germany. So I always tell the families, rather do a little, concentrate your private equity portfolios rather in the United States or in Asia, because you have enough assets in Europe anyways. So I always work against the home bias and try them to, I mean, that's a very personal thing. I mean, you have people, they say, well, the only place to invest money is in the US. And others say, well, this is all cowboy country, and I don't like to invest in the United States. And well, for me personally, I would always feel very comfortable having at least 30% of my worth in North America. So I rather have an over allocation in the United States and in Asia. And then, I mean, you also asked about Asia. In Asia, it's definitely still an emerging space there, but that can give you spectacular returns. We had the experience also like 6, 7, 8 years ago when I talked to clients about investing in Asia. They were like, well, if I invest in Asia, it's more risky than investing in Europe or in the US. So I want more return. I totally understand this thinking, but it was not possible. You could not get a higher PE return in Asia. And nowadays, the discussion is totally different. It's more risky not to invest in Asia than to be invested. We go there, we do due diligence in Hong Kong, in Beijing, and we try to get a feeling on the ground for the right teams. And Yeah, we found some really good managers, large and small. And so we do quite some allocation over there.
Thank you for sharing. What is your approach to identifying risk factors that can lead to permanent impairment of capital?
Oh, that's a very good question. Also a very difficult question. Yeah, I'm sure you're familiar with the Warren Buffett quote, rule number 1, never lose money. Rule number 2, never forget rule number 1. I mean, that's just the heart of compounding. And if you want to do compounding, you should not lose money on the way. So that's very difficult. And that's where the margin of safety comes into play. It's at the heart of what we do, try to identify what can go wrong. And that doesn't matter if we're talking about private equity or listed equity or real estate or whatnot. It's always the same question. We have toolkit 8 factors that we always apply no matter which asset class. And for example, one first question that we always ask, does the manager that we give money to have skin in the game? I mean, this very old, silly in a way aspect, but it's the one that is so important. And if you get the right answer on that, and then you have alignment of interest, that's a very, very positive. I mean, in Hamburg, we are a shipping city. And I mean, it's a very good example here because we had lots of shipping companies here. And there used to be a time when the guys who run the shipping companies, they would run, for example, 20 or 30 ships. And then they would have their equity in 3 of these 30 ships. And the rest would only be with other people's money. Now you guess which ships never lost money. It's so funny. I mean, even in the biggest crisis, the ships that had the money of the entrepreneur somehow came through, and the others didn't. And it's a simple factor, but we always follow this. So we probably lose quite a lot of interesting deals because there's no skin in the game or too little, but we're fine with that because the risk side is so important for us.
Well said. How do you achieve transparent planning, analysis, and implementation without conflict of interest?
That's an easy question for us because it's at the heart of our business model. We are not an asset manager. I mean, that's the problem when you, for example, it's about a listed equity portfolio and you go to a bank and say, well, is your portfolio the best? Of course, it's the best. When you come to us, we're an independent advisory firm. We don't take any kickbacks. The only guy who pays us is our client. They ask us question. We do a very neutral and independent screen of what's available, who can kind of fulfill the required criteria. And then we present them to our clients, whether, they get a 30-page analysis of what are the risks, what are the chances to give this guy or that guy money with a strategy. And then it's our client who will decide. There is actually no conflict of interest involved.
So being independent is very, very positive, and that's different than most firms sitting in Germany at this point.
Yeah, absolutely, and also the structure of our company is kind of working in our favor. I mean, we are just 3 guys owning the company. Nobody else has shares. We will try to give more people in our company. I mean, we're 70 people now, so we will try to give more people shares of the company, but nobody from the outside. It's the entrepreneurial families that are our clients, they're very much like that because it's kind of from, I don't know, they feel at arm's length. They like to talk to other entrepreneurs in a way. And so it's at the same level field somehow.
Sometimes it's also very interesting to look at deals that have not worked out the way you had hoped at the beginning. Could you tell us about the worst deal and what you've learned from that experience?
That's a great question, Cliff. I love it because actually that's the way we think. I mean, you always have to try to learn from your mistakes. And well, there's one example that comes to my mind because it's kind of it's a real estate project that we did, and it looked really nice. It was a building with a hotel, and it had some apartments, and it had a cinema, and it had parking spaces, and it sounded also good. And every one of these aspects had a manager who actually knew the field, the guy who did the cinema is kind of the leading cinema guy in Germany, etc., etc. And it all made a lot of sense. And then it all fell apart at some stage. And the main failure or where we didn't kind of understand enough of the project was it was too complex. And when it came to building this project, it was too complex to handle. So the costs were running out of the budget, and at some stage they closed they made a forward deal and sold the project, but they hadn't closed all the cost side. The cost side was still open, but they sold already. And that was a huge problem. And I mean, we do manager selection. So it was too late. We saw too late the complexity of the project and that the calculation could not work out. That was a big problem. And we're very, very aware of this now. And I'm sure that will not happen again. But that was really a big learning experience. And we lost money on that. And it felt really bad, and it was bad for our clients. And it's always nice to talk about 14, 20, whatever percent good investments. But I mean, we have actually we have 6 investments of the 169 that didn't work out, and this was the worst. And then one is minus 2%, and one was minus 15%. And I think overall it's okay, but still those were mistakes that we made.
Okay. Let's go back to one of the earlier conversations we had. Tell me more about the Kontora Academy, specifically the structure, the content, and who is it for? Because I was excited to hear this. I think it's really advantageous when I find a leader like you and your team putting an academy together and what that can bring forth to the client and the community. Tell me more.
Yeah, I love to talk about it because it's basically what makes us go around. I mean, it's all about learning. It's about also teaching, but also we learn a lot from our clients. They're very driven and intelligent and great guys. And investing is a difficult area. And funny enough, at least in Germany, investing is not taught at any university. Yeah, you have finance courses, etc., etc. But I mean, something like what Columbia School does not exist over here. So we have modules where you learn about what is private equity. We have modules where you learn, all the different asset classes. But then most important module from my point of view is the one that the co-founder, Stefan Buchwald, held. And that's about, is there something that over centuries, the successful families all done? Are there common rules that you can follow? And yes, they are common rules. And if you look at what families who have built huge wealth done over centuries, you always come to the same conclusions. And that's so funny. You don't have to, invent it for new. You just have to be very disciplined and look at, what others have done in the past, and then try to apply it with the same discipline. And for example, one thing that you'll find that in old Jewish families, you will find that in all over the world, it's the same principles. For example, diversification and trying to drive down on the correlation between risk is something that has been done for centuries. They had different names. It wasn't called alternative investments. Maybe it was the land. You have to own land. Or what now for us, for example, listed equity, private equity, or direct investment in companies is basically the same risk that you buy. You buy into future cash flows of companies. Find that family Fugger. It's an old German family who they made deals with the Pope at one point. I mean, centuries ago. But that's the same principle. They had some of their money in land, some of the money in real estate, and some of the money in companies. That's what they did. And basically, it's the same idea that we try to tell our clients. Our clients try to have real estate, then corporate cash flows, and alternative investment, which is basically the bucket of everything else. It's working fine. It's great.
What are the key benefits of illiquid assets?
I think it's a bit counterintuitive because most people think it's great to have liquidity. But when it comes to successful investing, the biggest problem is not the market and is not intelligence or something. It's having your own behavior in check. So illiquid investment help you because you're stuck. For example, how many people have sold stock in spring 2020 when the coronavirus hit? A lot. And then it took them, and then they sold. And then it took them a long time before they re-entered into the stock market. Well, they messed it up because, I mean, nobody could have foreseen that we get such a quick rebound. We see the illiquidity premium as something really valuable, and it's helping everyone to have their own feelings in check in a way. So that's what we try to teach in a way. Most entrepreneurs they grasp this immediately, and I mean in their companies they've done it for years because it's what they do. They always think long term, and suddenly only because it's possible to trade every day, people think that stocks is just a financial product, but it's basically having a share in a business. I mean, you wouldn't have the idea of because the prices of your apartment went up to sell your apartment the next day. You wouldn't do it, but with stock you do it. It's funny, but that's how human nature is. And I mean, Daniel Kahneman and others have shown us all it's all the problems are always in ourselves. Yeah.
What are the factors that determine or affect the asset's liquidity or illiquidity?
Could you elaborate?
Sure. When you look at an asset, we're an asset class. We look at liquidity and then the illiquidity. So, you look at some private equity, venture capital. Some of the capital at points for the high net worth or ultra high net worth individual has a timeline where they want to put those assets to work. So liquidity and illiquidity at this point does come into roles. When do they need those proceeds returned to them, or do they? So when you understand that balance that takes place.
Yeah, it's always important. I mean, we advise our families to generally have at least 10% of their net worth in cash, no matter where rates are. That's very important. And then, of course, you have to manage your liquidity. I would say most of our families, they have about 50 to 60% of their investments in illiquid investments and the rest in liquid investments. And that kind of, I mean, but I must say, I'm talking about families with net worth north of 50 million euro, so I mean, that's a different kind of problem.
Very, very good. How is illiquidity reflected in the expected returns?
Yeah, it's I mean, we talked about it. It's a illiquid premium, and I mean, I wouldn't say it now as 1% or it's 2% or how much it is, but it's important. Very much believe in the illiquidity premium, and that's what our results for the last 16 years have shown. I love investing in the stock market, so I'm not a purely illiquid guy, but but I treat it pretty much like an illiquid investment.
Very good. What are the personal rewards for you in doing what you do, and what do you love about your career choice?
It's basically working with these hard-driving entrepreneurs. And that makes me get up in the morning. And if I know I have a call or I have a strategic meeting with one of my clients, it just makes my day because I always learn a lot from them. They make me think in new ways. If I have figured out a great investment and I present it to them, and they really get to the heart of the investment and the risk reward profile within minutes, and then kind of getting them to, I don't know, agree with me or disagree with me is something that is very fulfilling for me.
So it's a friendship and a business relationship. It's together.
Yeah, I would say so. I mean, some of our clients are definitely in the top 5 table for me of people from whom I've learned the most, definitely.
Very positive. Tell me about your legacy you've built.
Well, at the beginning of our conversation, I told you about the financial situation, financial market in Germany and the situation we have here, where I always feel we're very much behind what's just the normal stuff in the US. And we're just not a leading nation when it comes to investing. And if I or we at Kontora can help kind of do a bit of education that people over here also invest their money, with the ideas that have worked for centuries, that would be great if we could have, that little impact and help on that front.
So the educational side of it is a very strong contribution you make to the clients, their families, the next generations. And I think that's a very, very positive leading indicator of why your firm is thriving.
I hope so.
Well, I'm proud of you. Patrick, share with me your email address.
That's Patrick, Patrick, dot, now it's getting difficult, Maurenbrecher, Maurenbrecher, at Kontora, Kontora.com. Sorry, Kontora.
Okay. I'll spell it for our listeners also to make it easier. It's Patrick, that's Patrick, dot Maurenbrecher at Kontora.com. And their website is Kontora.com. Again, that's Kontora.com. I want to thank you to our listeners, and I look forward to being back with you shortly for another episode of Private Equity's Profits Podcast. This show has been produced by Market Domination, LLC.